I'm going to get in a stakeholder here and get in his reaction. Ajit Mittal from the Indiabulls group. Ajit, hi. Welcome back. Our conversation was cut short because, we had to cut to Shaktikant Das the previous time. But surprise, surprise, no downgrade of commercial realty loan if the delay indeed is genuine. A big ask from your industry and you get it now. What does it mean for commercial real estate prospects now?
Well, this is a positive step. I must say this was a long-standing demand of the real estate sector as well as the financial sector, who are the loans provided to the commercial real estate developer. Bulk of the loans to the commercial real estate is coming from the NBFCs, HFC sector, while the banks are also funding this sector. But it's majorly the NBFC sector which is really at the forefront of providing funding to the commercial real estate. So given the fact that for the last 1.5 years, the NBFC sector was going through one of the worst onslaughts of the liquidity squeeze, this measure definitely comes like a breath of fresh air. But this, I must tell you, is just part of the series of measures that are initiated already or are being initiated. If you remember, the Honorable Finance Minister in the budget statement has clearly articulated, of course the fine print is yet to come, that they'll also provide some kind of liquidity mechanism to enhance liquidity to the NBFC sector. So while we were waiting that there could be some announcement in that direction as well, so that hasn't come in as yet, but we're expecting that there'll be something more which would be more in the nature of providing a kind of partial sovereign guarantee to the securities being issued by NBFCs, HFCs. Having said that, this 1-year window for the restructuring of commercial real estate is definitely a very, very welcome move. Also added to that, of course, is primarily for the banks, that all the lending for the retail loans, essentially auto and home loans, they would be exempt from the CRR requirement. So that also frees up a considerable amount of liquidity for on lending to these sectors, housing sector. So, all is welcome, but whether it's enough, early days yet. I'm expecting some more thing by way of very concrete measure to enhance actual liquidity flow to the NBFC, HFC sector by way of what was promised in the budget. So probably the time between budget presentation and the monetary policy statement was too little. So I guess that's a work in progress. So maybe in a week to 10 days time, we'll see some direction, some improvement in that direction as well.
Ajit, trust me, we're as hopeful as you are. But stay with us. We also have Dinesh Kumar Khara as well as R. Sivakumar joining in. And before I go to them, Ajit, one more question for you. Just on the practicality and implementation of this, do you really think it's going to be easy to identify a genuine from a non-genuine delay?
I do admit there's a bit of subjectivity in that. But I guess, the projects which are stuck up are all on account of genuine factors. At least the tier 1 builders and developers where, particularly in big cities, metro cities, the projects are stuck up. I know it more particularly because I'm also on the housing finance side. I am also representing a group which is one of the largest real estate developers. So I can bring a perspective that, it won't be really hard to identify and justify that this project is a bona fide project for the purpose of classifying it as standard, even if it is delayed, by 1 year. And another thing I would like to clarify, although you didn't ask me, see, there's a bit of confusion that the RBI statement says that this is commercial real estate only. Well, when we popularly we understand commercial real estate by office spaces, malls, shops and all. But from a lender's perspective, commercial real estate, any project finance in the real estate side, whether it is residential or commercial office space, is all commercial real estate. So all the housing projects which are stuck on account of these kind of reasons would also qualify for this dispensation.
Well, that's in fact interesting to know. Let me take it across to Mr. Mallikarjun Rao before we go to Mr. Khara. Mr. Rao, do you also believe that when you're talking about commercial real estate, all the stuck housing projects, if there's a genuine issue there, they will also be coming under this ambit?
Yes, I do believe that, because when we call as a bank, it is a housing finance is different. Commercial real estate is, it could be the project which is meant for housing as well as for office space.
Okay, let me take it across to Mr. Dinesh Khara. He's also joining us on the broadcast. Mr. Khara, let me take it across to you. How do you see the RBI's move with respect to easing and giving a CRR leeway for consumer loans? The idea, of course, is to spur demand. Do you think that's going to do enough? And also the big bonanza coming in for the real estate sector. This is a story that my colleague Nentara broke, just a few days ago, that there's a one-time restructuring that is being talked about for the real estate sector and relief coming in for MSMEs as well.
Thank you very much, first of all, for having me on your channel. When it comes to the RBI current policy, which has been announced just some time back, I would like to mention that it is positive in terms of the kind of relaxation which they have offered to CRR for particularly housing, SME, and the automobile sector. I think this is essentially an attempt on the part of RBI to boost the demand in all these personal consumption loans. So it will, the preemption will lead to a situation, relief on the preemption will lead to a situation where the cost of credit can come down. So I think to that extent it's a real positive. And then the other very important issue is the long-term repo from 1 year to 3 years, which is essentially an effort to provide the long-term durable liquidity in the market. The other issue which has been addressed is in the MSME sector, where they have extended the relief till December 2020. So any restructuring will not really lead to the downgrading of the asset class. So I think it is an attempt to address or mitigate the hardships of the SME sector, which is actually experiencing some kind of a challenge in terms of their receivable realization. And the last but not the least is relating to the CRE sector, where they have extended the DCCO for another 1 year for the genuine reasons. So that is something that's again a very welcome step, because as of now, when it comes to the commercial real estate sector, at times they are confronted with the situation of demand, and also there's a delay in execution also in the projects. So I think I would say that it's a very, very pragmatic policy which has been brought in by RBI at this point of time, when we are trying to push the growth rate in the economy, and the growth is expected to ride on the increase in demand. So that is something, to that extent, I think it's a very well-rounded, very well thought of policy which has been brought in by RBI.
Just want to mark what the market as well is up to before I toss it back to Maithili. And Nilesh, I want you to comment in here. Just wondering and mesmerized as to what a beast this market is. From Saturday's crash post-budget to the kind of recovery that you've seen to the next event, which is only 4 days today, 12,145 back on the ticker. The breath, of course, has been holding up from the word go today largely, and has been the case for the last 5 weeks. But I just want to, showcase some of the stocks wherein you're seeing an immediate knee-jerk positive reaction. Look at what an LIC Housing Finance is up to. That's 7% higher on the futures right now. Shriram Transport Finance, another 7.5% bump up there. L&T Finance, which is holding up 8.6% on the future. Piramal Enterprises, for the last 2 days, this stock has been getting hammered out, currently higher by about 9.25%. So an immediate short squeeze coming in all of these stocks. And Indiabulls Housing Finance, which is holding up 11.5%. Nilesh, not just the market reaction, but purely from a messaging point of view, while we know traditionally the Reserve Bank has been an inflation warrior, from here onwards, what do you think is going to be more critical, to tackle inflation or bring growth back, and thereby then cut rates? Because they've been maintaining this accommodative stance. They've talked about as to how growth is continuing to look muted, and it's on their radar.
I think the Saturday's reaction in market was in anticipation of Chinese market coming down heavily on Monday, and what happened to Dow on Friday. On Friday, Dow was down 600 points, or about 2%, and on Monday, China was expected to go down by 10%. But today, when we are seeing newspaper reports that finally coronavirus additions seems to be coming under control, there is confidence in the market that hopefully this will not become a bigger scare. There are 2-3 advantages coming from coronavirus to India. One, it has promptly reduced oil prices. Current oil prices at $55-56 a barrel are immensely beneficial to Indian economy. The second thing is that globally most central banks have become cautious because of coronavirus scare. They are either cutting interest rates or providing liquidity. China led by pumping $172 billion in their economy. Whenever such liquidity is infused in global banking system, global economy, some of that does pass it on to emerging markets, including India. The third and the bigger thing is a lot of FPIs will be looking to exit China, book their profit in China, or diversify out of China. Now, as long as these FPIs are exiting China but not emerging market, reallocation will happen and some of that money could come to India. So lower oil prices, higher liquidity and lower interest rates globally, exit China to enter India possibly becoming a trend. All these things put together, markets have resulted into a short squeeze and stocks have bounced back before Saturday level.
Okay. So this is Maithili speaking from the RBI after the governor's presser, and my question is addressed both to Khara as well as to Mr. Mallikarjun Rao. Dinesh, the RBI has made some concessions, as it were, to real estate, MSME, auto sectors, but it's a very convoluted kind of relaxation that has been given. Incremental credit over 31st January up to 31st July, that amount can be exempted from NDTL for calculation of CRR. How much of an impact will this make, do you think, as far as banks are concerned? Speaking of SBI, Dinesh, how much of a difference will it really make for these sectors?
Well, as far as my assessment goes relating to these kind of relaxations which have been extended for a 6 months to 1 year time, I think this is, as I was indicating, that it is essentially to rev up the demand in the economy, and it is to encourage the banks to go ahead and lend into these sectors more aggressively. So I think it's to that extent they would wait and watch and how really things move. Depending upon that, perhaps there could be revisiting these decisions also by RBI. That's what my sense is. And I think when it comes to the kind of a relief which has been given to the CRE, the commercial real estate sector, and also for MSME for the restructuring for 1 year, that's a fairly good time if you really ask me. And we will get to see the results in this kind of a period. And if the units are coming out of, the intention is that these are the temporary reliefs, and not that it is expected to be permanent in nature. And essentially this is with a very clear intention to revive the demand in the economy and to push the growth rate in the economy. I think it's a very clear intent which has been articulated in the policy decisions.
Let me just go to Mr. Mallikarjun Rao and ask him whether he shares Dinesh's views, because ultimately, all these things, unless they translate into lower interest rates, and also assume that lower interest will incentivize demand, do you really think this will prove the kicker as far as automobile, residential real estate, MSMEs is concerned? Of course, MSMEs also have the additional advantage of 1 further year for restructuring. Do you see a substantial pickup in bank credit to these sectors, Mr. Rao?
Yeah, you see, technically, if you look at for funding to these sectors like housing loans, MSME and car loans, banks are already having liquidity. So you can ask a question, when liquidity is there, why there is a requirement? The question is costing. The costing for lending will get reduced because it has to be removed from the CRR. That is one advantage, number one. Number two, for car loans, we have seen NBFC segment being under pressure. The kind of model they were following, there was a pressure in lending to car loans. So this is additional advantage for banks to take it forward more aggressively in lending to these three sectors. Additionally, in MSME segment, the forbearance up to December 20, here there is a change. Earlier, when it was available up to March 2020, it was the standard asset as on 1st January 2019. Today it is adjusted to 1st January 2020. That means the accounts which are covered under this dispensation are many more. This is another advantage. The stress is already there for the last couple of years or little more in the MSME segment. At least the genuine cases where units are ongoing, this kind of an advantage will give them an opportunity to tie up with these problems. So from the perspective overall, if you look at even if the window of CRR is available only up to July, it is a good move to see that the lending rates could be moderated. Another dimension is to include medium enterprises for the external benchmarking effective from 1st of April. All these measures will provide an advantage. Then why only 6 months, why not 1 year? Already RBI has opened another window, that is a repo for 1 year and 3 years, to pump 1 lakh crore where the liquidity will be much more available. So really, if you look at if the demand increases in the days to come, there won't be any funds crunch for the banks.
No, except that, Mr. Rao, there already is no funds crunch to the banks. And we are moving to a situation where we want floating rate loans. So really, does this make a difference, Mr. Rao?
Yeah, it will make a difference. The reason is, see, if you look at the repo rates have fallen up to 135 basis points from February 19, but the real transmission has taken place up to 50 basis points predominantly because the deposit rates have not gone down. Deposit rates not have gone down because even small savings rates are also holding on to that. Now, for the first time, the window of liquidity will provide an opportunity as a matter of cost of funds defining the lending, because the window is available for 1 year and 3 years. So I would look at it that way, that not only the deposits which are going to define the credit deployment, even the repo window of 1 year and 3 years, if you are able to properly plan at the bank level, could be used for lending effectively where cost of funds is less.
Okay. Let me now move to Mr. Mittal. Mr. Mittal, there have been a number of concessions both for residential housing and also for commercial real estate. Will this really move the needle as far as a slump we are seeing in the real estate segment? Because people were disappointed that the budget did not contain too many stops for the real estate sector. Has the RBI made up for that, Mr. Mittal?
Well, that's not really RBI's domain. As one of the earlier panelists also said, that this does address to an extent the supply side issue. But the demand, while I do understand as an economist and as a housing finance man, also a real estate developer, there is pent-up demand in the economy, but somehow the buyers have not been forthcoming. So while there is a lot of unsold inventory also available, there are projects stuck up equally, that is exacerbating the situation. So something needs to be done to sort of kickstart the demand. While there is a latent potential for an economy like us, given the demography, we have in our country, but commensurate with that, we don't see the demand coming up. So for that to kickstart, there has to be a very sort of meaningful incentivization, which was being considered at the government, and I was party to some of the meetings at highest level in the government. So I guess that probably also needs to, come forth so that you supplement these supply side effort with some kind of real demand push. So I do agree that this is by itself is not going to be enough to sort of really give a meaningful impetus to the demand.
Mr. Shivkumar, the MPC's resolution and the stance, etc., was quite dovish. But the governor at the press conference made it very clear that just because RBI has maintained status quo for now, don't take it as a pointer to what the RBI will do later. And he also said, don't discount the RBI. We have many tricks, quote unquote, that is my version actually, tricks up our sleeve. And we can always act whenever we think the time is appropriate. So was it a bit of an iron fist and a velvet glove, Mr. Shivkumar?
I don't see there's an iron fist here. This was a very dovish. This is at best, as dovish as you can imagine, an RBI which is essentially focused completely on growth, focused on credit and monetary transmission. So this is first time in years that I can almost call this policy a credit policy of old times, where the focus is completely on bank credit. And in addition, of course, making a statement that the pause for now does not mean a pause on rates, which means there's an opportunity to cut rates in the future. So I think on all fronts, whether it's a rates front with a softer guidance, with the focus on transmission and all of these credit-related moves, I think this is an RBI clearly focused on growth and wants to be seen as quite dovish.
Dinesh, you know, the RBI said that the long-term, at the press conference, the governor rather said that the long-term repo will not replace the OMOs and will continue with OMOs at a time when there's so much of surplus liquidity and RBI's daily absorption has got up to over 3 lakh crores. Does it make sense to keep pumping in liquidity, keep doing Operation Twist unless demand picks up? And what do you do to increase demand? Ultimately, growth is the only answer, Dinesh. So do you think the RBI has done whatever it could and there's nothing further it can do as far as growth is concerned, Dinesh? Dinesh, that is addressed to you, Dinesh Khara, that was addressed to you, Dinesh. That the RBI said, the governor said that they will continue to do long-term repo along with, you know, the OMOs and things like Operation Twist, etc. in a bid. He, of course, tried to clarify that the Operation Twist was done to lower their interest rates on corporate bonds and not really to ensure that government borrowing went cheap. I'm not sure how many people took that at face value, but even if we take that at face value, has the RBI done enough and more as far as the supply side really is concerned? There is money, but nobody's taking it. So is the answer really lie ultimately in growth? And that is something over which RBI has very little control. Dinesh?
Well, of course, when it comes to long-term repo, the intention is to provide the durable liquidity in the system. Though currently a banking system is in surplus at more than 300,000 crore, that is a kind of a number which we get to see. Now, when it comes to Operation Twist, the attempt is to really shift the yield curve. And when it comes to OMO, that is actually moving down the yield curve. So actually, these are 3 different objectives which are attempted through these 3 different means. So I would say that, you know, it is not merely the attempt is to provide liquidity, but also the durable liquidity, which is an attempt. And OMO will have a very different purpose. It will only move the interest rates down the yield curve. And the Operation Twist is actually shifting the yield curve itself. So that is, I mean, these have got the different objectives which they have in mind while having these 3 different instruments.
Yeah. Yeah, there are finer differences, I agree. But Shivkumar, would you agree that the governor, in fact, pointed out quite proudly, if I may say so, to how the transmission had improved, especially as far as money market instruments are concerned, and also Government of India securities. Now, how much is it really because of monetary policy transmission, and how much it would be because of Operation Twist? I'm not sure this is really the benefits of the transmission mechanism as much as RBI's Operation Twist. Would you agree that the Operation Twist played a substantial role in keeping interest rates low at the long and the short term as far as G6 were concerned? Mr. Shivkumar?
Yeah, I kind of buy that point, and I think we need to see this as a kind of this term repos as some kind of a mini Operation Twist in the 3-year segment also. So effectively what they're saying is we have been able to bring down the rates on money market instruments by in fact more than 135 basis points. So by doing a kind of a term repo, they want to flatten the curve between the money market to 3 years, and the Operation Twist is looking to flatten the curve all the way up to 10 years. So effectively what the RBI is signaling is that they want more the rest of the yield curve to flatten, whether it's a 3-year segment or the 10-year segment. So this is a more stronger statement that these LTROs or the long-term repos are not replacing OMO. So effectively, or Operation Twist. So effectively, what they are saying is an additional tool. They would want to continue to keep a lid on long-term rates, but now they are also targeting a different segment of the yield curve. It's important to remember when they are using an instrument like term repo that unlike an OMO, while the repo itself is a 3-year instrument, the assets which they can buy in the repo could be much longer. So effectively, a bank which may hold a 10 or a 15-year security can pledge that for the next 3 years to get liquidity against that. So in effect, I think what the RBI is signaling is that in the 3-year segment, probably rather than doing a 3-year OMO which may have limited success, a 3-year term repo may be more impactful, and then using a tool like open market operations or Operation Twist to affect the longer end of the curve. The other point is, of course, when your benchmark G-Sec yields come down, the transmission into corporate bonds will happen in sync, or I should not say 1:1, but definitely will happen in sync. It's been our call for the last several months, maybe leading a year, that we prefer corporate bonds over G-Secs for this very purpose. We believe that even though the G-Sec curve is coming down, we actually see more value in corporates. And now the RBI governor himself comes out and says that the reason for doing Operation Twist is to actually bring corporate bond yields down. And I think it really plays into, I think, that part of the curve.
Okay, so you do see corporates, you do see especially overseas investors, and I repeat, overseas investors using that leeway given in the budget to buy more into corporate bonds. And I repeat here again, despite the problems that we have about contract enforcement in India, so as long as your bonds are being serviced, there's no problem. But once the corporate which has issued the bond runs into trouble, then God help you. But you believe that overseas investors would still be interested in corporate bonds. Is that right, Mr. Shiv Kumar?
Yeah, I think, see, when we are talking about corporate bonds, remember that public sector corporate bonds, AAA bonds, these are the ones which will benefit the first from a move down in sovereign yields. So, we are not really talking about going out into the credit curve. The credit curve, I think they are trying to impact through the banking channel. So, if the bank lending rates come down, that will bring credit curves down. What I think the RBI can target using the monetary operations is the quality part of it, the AAA part of it, and the public sector AAA issuers or the private sector AAA issuers, which I think will be the biggest beneficiary of these Operation Twist and the monetary operations. The operations that they're doing on the credit side, which include the restructurings and encouraging banks to lend, I think that will eventually lead to compression of the AA or lower rated instruments. Those spreads will compress as the banks enter that part of the market.
Mr. Mallikarjun Rao, many thanks for taking your time out and speaking to us. Also, let me thank Maithili as well for giving in her perspective.